FMCG major HUL has come out with its earnings, and this time it's a miss coming in on all the parameters, especially onto the margin figure. If we see, then the company has posted a margin number of close to 23%. This time the number is at 23.2%, and you will see that there's a miss because we were expecting the number to be in the range of 23 to 24%. In terms of the growth on their revenue front, so the company has reported around 15,188 crores in the top line, but that's absolutely flat. EBITDA jump is also flat at 3,540 odd crores. The margins are flat too because this time the street was expecting an improvement of close to 80 basis points, but that doesn't seem to happening. And the net profit as well, a miss there, 2,519 crores is what the company has reported. We are getting to understand that the underlying volume is at around 2%. Other than that, the expectation was actually of 2 to 3%. So a marginal miss on that front as well, I believe. But let's get a more sense on the HUL earnings and how the analysts picking up, what are their first cut coming in on the numbers. And with this, let me welcome Abneesh Roy, Executive Director at Nuvama Institutional Equities. Abneesh, hi, very good afternoon, and thank you so much for your time. What are your first analysis on HUL? Because the company has been giving the commentary on the slowdown in the rural, but the urban has been holding up. But this time, the volumes is a bit of a disappointment coming in versus our expectation. What's your first analysis?
So yes, slightly weaker than the street expectation. Versus ours, it's a bit closer. So there is a miss of 1 or 2% on most of the line items. So yeah, the expectations anyway were muted, and against that, it's a bit lower. In terms of volume growth of 2%, we had already highlighted that there is a rural slowdown, and the growth is essentially coming from urban. There is a local player issue in lower-end detergent and tea, etc., which is also impacting all the national players. So that's on the volume front. In terms of pricing, if you see clearly, it is negative this quarter. So that is happening because in detergent and soaps, a lot of prices were passed on to customer because the gross margins had expanded by the entire industry, and that's a very normal thing in FMCG. When there is a sharp gross margin expansion, companies pass on partially to the customer. In terms of margins, also there is a miss this quarter. Broadly, the street and we were working with a 24% kind of EBITDA margin. But two things have impacted. Clearly, lack of operating leverage because revenue is also 2% lower than the street. So that's also impacting. Plus, what had happened was when the Israel-Hamas crisis happened, the crude oil had gone up in the initial part of the quarter, and there is almost 1 to 2 month of lag effect. So that's why in Q3, momentarily, the margins have come down. We expect that in Q4, the margin recovery should again be there because, again, crude has cooled off. So these are the 3-4 key things. Rural slowdown, pricing being negative because soaps, detergent, and a lot of those saw price cuts, and the crude had gone up initially in the quarter. So those are the three issues.
Thank you so much, Abneesh, for highlighting all the factors that could have been at play for the Q3 earnings. But Abneesh, another concern throughout the quarter that we have been discussing and reporting as well, that the company was having some troubles regarding their distribution, especially in the state of Maharashtra, though it was not a nationwide disturbance there. But is that something that you will be watching out for when it comes to the management commentary? Do you require any more clarity on those fronts?
So that is quite routine. If you see FMCG companies and the Kirana, this issue is nothing new. This keeps happening. If you see, the broader theme is that the Kirana distribution is losing market share definitely to e-commerce, modern trade, quick commerce. So that's a theme which is going to help FMCG company longer term in terms of diversifying their risk and not just get exposed to Kirana. Second, of course, is there is a volume slowdown and companies will look at incentivizing higher focus on volume growth, and that you can do by incentivizing in terms of productivity. The distribution cost has to be linked to the productivity, and based on that only the better performing distributors should be paid. That's very routine in any kind of a professional transaction. So I will say this is nothing new and this keeps happening. The real important thing is what's happening on the rural slowdown. So that I think in Q4 also mostly rural slowdown continues. In Q3, winter demand was also weak. If you remember, all the companies saw because of late winter, the skin cream and all that did suffer for HUL also. So those are the issues which impacted Q3. So my main question will be on the demand side rather than on the distributor. That's a routine thing. I will not be too worried on that.
Point taken, but let me get a larger sense on the FMCG segment then, because Nifty FMCG has been underperforming for quite some time in HUL because it is such a big player in the FMCG segment, and with results that are subdued like this, what kind of impact are you seeing on the overall FMCG space with these numbers as well?
So we will wait for the other results. This is the Hindustan Unilever results. We continue to prefer Nestle, Tata Consumer, Godrej Consumers kind of companies. We also like ITC. So yes, definitely this is the initial part of the FMCG results. We had seen Asian Paints also come out, so that did much better in terms of the volume growth. So ultimately, there will be players which will do much better in Q3 also. So Nestle, Tata Consumer, etc., as I highlighted. But most other companies will see the rural slowdown, and that's being clearly seen in HUL results also. There could be some profit booking in some of the names, but definitely from a Q4 perspective and FY25 perspective, things will improve. Also, what's happening on the FII inflow, that also matters, right? So we do expect FII inflow to pick up. Last few days there is a sell-off, but those things can definitely change. So we are expecting volume recovery, pricing recovery for HUL in FY25. And as I said, in Q4, the margins will be better. So stocks don't react just based on the specific quarter. Yes, on Monday, there could be some reaction based on the broader market and the slight miss which HUL has seen. But if you see, HUL stock last 1 year, anyway, the stock has gone nowhere. So to that extent, I don't expect a very sharp reaction. Because the miss is slight only, plus the stock hasn't done well anyway. So a lot of that is already factored in.
Right, Abneesh, with this, we'll let you go on that. And thank you for joining us today with the first cut analysis on HUL. So that was the earnings of HUL, where this time it has been a miss, especially on the back of a lower volume growth led by the rural demand as well as the higher crude prices. But going ahead, lower crude prices are expected to give some boost to the margin figure. But